This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 3 videos on orders. There are only 4 orders that most traders should be using. Beginners should be entering only with stop orders. Experienced traders can also enter with limit orders. Beginners can exit with limit orders. Bracket orders: after you enter a trade, you should be using a bracket order, a stop order to protect you, and a limit order to take profits. And finally, I'll talk about market orders. Sometimes the market is just moving too fast and you need to get in or get out. The best way to do it is trading at the market. There are other order types as well, but most traders should not bother with them. Most traders should only use these 4 types of orders: stop orders, limit orders, bracket orders, which are a combination of a stop plus a limit order, and market orders. When you open an account with your broker, he'll give you software that will allow you to trade, and these will be choices that are available in that software. They allow you to enter and exit trades. Most traders should almost always be entering with stop orders, because then at least the market is going in your direction. For example, to enter or exit a trade with a sell stop order, you place the order below the low of the current bar. For example, if you're long and you want to exit below this bear bar, you place a stop order just below its low. When this bar traded below that low, the stop order becomes a market order and you're filled at the market. You're not necessarily filled at your price. Sometimes the market will fall several ticks or pips below your price and then fill you, but at least you know as soon as the market falls to your price and touches your price, the stop order becomes a market order and you get filled at the next available opportunity. For example, if there are too many stop orders at the same price for the number of buy orders at that price, the orders that get entered first get filled first. If there are not enough buy orders to offset the sell orders at that price, the market has to go lower to fill the remaining sell orders. As a result, you may think you should get filled right below the low of this bar, but you could get filled quite a bit below the low of that bar. Again, if the market reaches your order, does not have to go through your order, it just has to touch your order becomes a market order and you will get filled. Rarely, if you're trying to enter or exit with a sell stop, the market will hit your stop and then bounce and you'll get filled at a better price than your stop order. If you're trying to enter or exit a trade with a buy stop order, you place the order above the high of the current bar. So for example, as this bar is forming, you decide that you want to buy above its high if the market goes above its high. Either to exit a short, maybe you sold below here, or to go long, thinking this is a pullback from this breakout. When the bar closes, you place a stop order to buy right above its high. As soon as the market goes above the high of this bar, it becomes a market order and you get filled on the next bar. If there are too many buy orders for the number of sell orders at the high of this bar, you may get filled at a worse price, and sometimes you could get filled at a much worse price. But if you trade a market that has a lot of volume, chances are you're going to get filled at your stop price or not much worse. If you're trading a stock that is priced at $1,000, you may get filled with 10, 20, or 50 cent slippage on every trade, and that is appropriate given the price of the stock. And even if you get a slippage of $1, in other words, if your fill is $1 worse than your entry price, that's no different from getting a 1 penny slippage on a $10 stock. As soon as you enter any trade, always place a protective stop. If you buy here, place a protective stop somewhere below, for example, here or here. If you sell here, let's say you sell to go short, place a protective stop somewhere, maybe above the high of this bar, but always have a protective stop in the market whenever you're in the market. A protective stop is a stop that protects you. It gets you out of a trade that is going against you. In fact, a protective stop is the single most important order that you'll ever use. Whenever you're in a trade, you should always have a protective stop in the market to protect you in case the market goes against you. It protects you mostly against yourself, especially if you're starting out, because if you did not have the stop there, you would be in denial, and often you'll exit after the market goes far against you. For example, let's say you sold to go short here, and you thought you might want to get out if it goes above the high of your entry bar or your signal bar here or here. And when it started to do that, you decided, well, maybe I'll give it more room. And you ended up exiting right here. If you had a protective stop, for example, above the high of this bar, you would have limited your losses. Without the protective stop, as a beginner, you'll usually exit at the worst price, and you'll probably buy back your short here with a huge loss. Beginners hate to admit that they're wrong, and there's an important reason behind that. They don't want to take a loss. They're afraid that if they keep taking losses, their account will disappear. And if they no longer have enough money in their account to place trades, then their dream of becoming a successful trader dies. Taking losses is the equivalent of death if you're starting out. However, you need the protection, because if you're simply relying on hoping that a bad trade reverses and goes your way, you'll quickly lose all of your money. If a bear sells below the low of this bar, he might place his stop, his protective stop, just above the high of the most recent lower high. Let's say this is the most recent lower high. He would place a stop just above that bar, and if the market touches his stop order, it becomes a market order and he gets out. If this is a market that has a lot of volume, he'll get filled at his stop price, or maybe just a little bit worse. If it's a market that has very little volume and the market hits a stop order, he may not get filled until here, much worse. That's called slippage, when the market goes beyond your order price and you get filled at a much worse price. A bull who buys this high or low might place his stop below the bottom of this bull bar or below the bottom of the pullback, which is just a little bit below. If the market touches that stop order, which is this gold line, his order becomes a market order and it gets filled immediately. Exchanges operate on a first in, first out basis. The orders that get placed first get filled first. If there are not enough orders on the opposite side, the market has to go lower, and that means traders who are trying to get out with a stop right here might get filled at a worse price. If the market is a heavily traded market, usually the worst price will not be much different from the intended price where you placed your order. Slippage can be very big if you're trading a thinly traded market. Another very important reason why you should place stop orders whenever you're in the market is because of black swan events. These are unanticipated market events, and they're real, and they come every now and then, and current systems, your broker, the exchanges, are not designed to prevent them because they're unanticipated. The theory behind black swans is that if you've only seen white swans, it's natural to believe that black swans do not exist. But they do exist, and just because you've never seen one does not mean that they do not exist. It might mean that they're uncommon and therefore low probability, but they're real. If you're trading, you have to protect yourself against these low probability extreme events, and that's one of the purposes of protective stops. Nobody knows the unknowable. The software developers, the hardware developers, the developers who create the equipment used by the exchanges, by your broker, by you. Nobody knows what is unknowable, and therefore nobody can design software and hardware to cover every possible thing that can happen, including black swans. All brokers get overwhelmed, all exchanges get overwhelmed and fail every 10 years or so. If you talk to your broker, they'll totally deny it. They'll say, oh no, we got really smart people, we have the world's best equipment, it can never happen. But I've seen it happen many times in my 30 years of trading. For example, in 1987, when I began trading, the market crashed. It lost 25% in one day, and nobody knew what the value of the market was until the end of the day. There were no prices all day long. In 2010, there was the flash crash, and the market lost 9% in 36 minutes. And this is at a time when everyone thought the world's best computers and the world's best software would prevent anything like that. And then if you go back to 1929, Black Friday, that was the start of a correction that lost 90% of the stock market value in 3 years. A protective stop is supposed to protect you, but it doesn't always give you the protection that you hoped. For example, this is Hewlett-Packard. Big gaps in stocks are common, especially after earnings reports, and a protective stop can get filled at a much worse price than you ever expected. Unexpected news events can also lead to huge gaps in the market. And the result is you think your stop is going to protect you, but your fill could be so bad that it's offering no protection at all. Here's Hewlett-Packard. Here's that same chart, but the bars are a little bit more compressed. And let's say you bought above this bull bar. We tried to reverse up repeatedly at the bottom of a trading range. It's a reasonable buy. And so you're long at 22.56. And to be safe, you place your stop order, your protective stop order, right below the bottom of this triangle. One tick below that low maybe. So your stop is at $21.99. Your risk is therefore 57 cents. You bought at $22.56 and you plan to get stopped out at $21.99. But remember, the first trade that touches your price or goes below your price makes your stop order a market order. And if you're long and this is the day before earnings, you have to be prepared for a surprise. And this is what happened. The next day, the market opened down here at 18. This is the first trade at or below your stop order. So your stop order becomes a market order down here, and you get filled around $18. Instead of risking 57 cents, you end up losing $4.56, not just 57 cents. Your stop offered no protection. However, you still need some kind of protection whenever you're taking a trade. If you're in a position going into an earnings event, buying puts provides much better protection than using a stop. The downside of buying puts is you're paying money. Puts cost money. Most of the time they'll end up expiring worthless. However, they avoid catastrophes like this. Most institutions, most professional traders protect themselves by buying puts to offset huge losses that can come from black swan events, like a much worse earnings report than anyone expected. This is a 60-minute chart of the dollar versus the Swiss franc. The market broke to the upside, it broke to the downside, and then reversed up twice. Pretty good sized bull bars. It's reasonable to go long above the high of this micro double bottom. Down, up, you buy on a stop maybe above that bar, and you get long right here. Whenever you're in a trade, you need to place a protective stop to protect you against the market going too far against you. If you buy here, you're filled at 1.0190. You might put a stop below this low, which is at 0136. Your risk is 54 pips from here to your stop. The first trade that takes place at or below your stop turns your stop into a market order. This risk to your stop is your minimum risk. It's not your absolute risk. You might be risking much more than that. Unanticipated news events can happen in any market, including currencies. And the result is your protective stop may not protect you much at all. It's rare, but it can happen. This is that same chart right up here. You bought here, and you put your stop here, and you thought you were risking 54 pips. However, the market opened with a huge gap down. You can see where it opened. It opened down here, and therefore, the first trade that takes place at or below your stop was right here, and that means you get filled right here. You were filled probably around 88.94. You thought that the most you could lose was 54 pips, but in reality, you lost 1,242 pips. Much worse than you thought. Therefore, your stop offered no protection at all. But that is a risk of trading Forex markets. This is very rare. This is the kind of thing you see once every 10 or 20 years, but it does happen, and because of that, you have to be aware of it. You have to trade small enough so that if a catastrophe like this happens, the loss is not unbearable. Forex markets often have small gaps, like on Sunday when they open. Huge gaps like this are very rare, but when you get them, your protective stop gave you no protection at all. You lost far more, 30 times more, 20 or 30 times more than what you thought was your maximum risk. Should you still have a stop in the market? Yes, you should always have a stop in the market. I want to talk a little bit about limit orders. Beginners use limit orders to take profits. Experts can enter with limit orders as well. Unlike a stop order that becomes a market order as soon as your stop price is touched, the market usually has to go past a limit order for you to get filled. Maybe 90% of the time it has to go through the limit order before your order gets filled. 10% of the time, if it touches your limit order, you will get filled. Let's say you buy with a stop above this pullback. We have a bull breakout and a pullback. You buy with a stop above the high of this bar and you get filled right there. And a scalper might want to exit with a minimum scalp, so he places a limit order at that minimum scalp price, this blue line, and as soon as the market goes above that blue line, he will be filled at his limit order price. Rarely he'll get filled at a better price. On the other hand, the scalper might decide that he wants a little bit more than a minimum scalp, and he might place his limit order to sell at the high of the bull trend. So he'll place a limit order to take profits here, to sell out of his long position here, and he would get filled here as soon as the market went above that price. If it touches that price, 90% of the time he will not get filled. It has to go above that price to make sure that you're filled. If it goes above the price, you will get filled. An experienced bear scalper might look at this and say, oh, we went down, we went up, we went down, we went up. This is probably a trading range, and therefore, if we break above the high of this bar, we're probably not going to go up very far. A bear scalper may place a limit order to go short at this high. For him to get filled, 90% of the time, it has to go at least a little bit above that high to get filled. Again, entering with limit orders is something that experienced traders can do. Beginners should only be entering with stops, because the market's racing up, and if you're selling, you have to be very comfortable being short in a market that's quickly going against you. And beginners invariably panic, and they end up exiting with a loss up here instead of with a profit down here. A bear scalper will look at this chart and see a probable trading range. He'll place a limit order at that high to go short. And as soon as the market goes above his order, he'll get filled, betting that the bull breakout will fail and reverse down. A limit order is basically the opposite of a stop order. A bull is getting stopped out above this bar. A limit order trader is placing his limit order to go short at the high of this bar. It usually has to go above the bar to get filled. The limit order bear is selling with a limit order. The stop order bull is buying. For example, if the bull wanted to buy a breakout, hoping for a measured move up, he'll buy with a stop just above the high of this bar. Or a bear who is short down here, he might have his stop above the high of this bar to get stopped out. So he'll buy back his short if the market gets just a little bit above this bar. The bear who sold at this high might be looking for a scalp. He'll place a limit order, the blue line, to get out at a scalp distance from his entry. He sold with a limit order, and he's looking to exit with a limit order. If the market falls below his limit order price, he'll get filled. If it simply falls exactly to his price, but not below, 90% of the time, he will not get filled. It usually has to go below his price to make sure his order is filled. If it does go below his price, he's guaranteed a fill. The scalper, instead of going for a minimum scalp, might hold and hope that the market falls below this low. He might place his limit order to take profit at this low and has to go below the price to get filled 90% of the time. A bull might say, okay, we went down, up and down and up and down. It's probably a trading range, and therefore the breakout below this low will fail. A bull experienced trader might place a limit order to buy at that low. He will go long at that low, and if the market fell a little bit below his entry price, he would get filled. And it did on this bar, although it's hard to see. The low of this bar is slightly below that gold line at the low over here. I now want to talk a little bit about bracket orders. A bracket order is a combination of a stop order and one or more limit orders. Whenever you're in any trade, you should always have a bracket order operating. It's a combination of two things, a protective stop order and a profit-taking limit order. A bracket order, it brackets the current market, the current price. It's also called an OCO order. Some brokers say OCO stands for order cancels order. Other brokers say one cancels other. And what it means is if you have a bracket order, a stop and a limit order, as soon as one of the two orders is filled, the other one gets canceled automatically, immediately. Most brokers will allow you to attach a bracket order to your entry order, which means you place an entry order, the bracket order then is created but not filled. As soon as your entry order is filled, your software and your broker automatically then place the bracket order. They automatically place both a stop order to protect you and a limit order where you can take profits. The order is created as soon as you place your order to enter the trade. The order does not get placed until your order to enter the trade is filled and you enter the trade. You get to decide how far away the orders are. How far should your stop be? How much are you willing to risk? How far should your profit-taking limit order should be? Some traders split the profit-taking limit order into 2 or 3 smaller orders. They want to scale out, take some profit quickly, and take other profit as the trade goes their way. For example, let's say you are long 3 units. Your stop, therefore, is for 3 units below the market, and your limit order, you might have 3 limit orders, each for 1 unit above. If the first one gets filled, you then have 2 contracts left. Your broker software will automatically change your stop to 2 contracts because now you're only long 2 contracts. When the second limit order gets filled, you're now long only 1 contract. Your software will automatically change the stop to 1 contract. Again, as soon as your entry order is filled, if you set up your software correctly so that you attach a bracket order to every entry order, your software then places the bracket order. If a bear sells on a stop below this bar, he should have an attached bracket order. And as soon as his order is filled, he gets filled as this bar goes below that low. He now has both a protective stop and a profit-taking limit order. For example, he might place a protective stop above the high of this bar. You can see this gold line is his stop just above the high of that bar. And he might want to take a profit down here, maybe 2 times his risk. You can see the distance to his stop is further than the distance to his profit-taking limit order. He can decide where to put the stop and where to put the profit-taking limit order, and they do not have to be at the same price. As soon as he gets stopped into the market, his attached bracket order becomes active, and he now has an active protective stop. If the market goes to this price, he'll get stopped out, and this order will disappear. If instead it goes down to his profit-taking limit order, it has to go through the order to fill it. Then he gets out of his position, and this stop will automatically get canceled. In this particular case, let's say he was trying to get out here. Instead of going down, the market went up. He got stopped out with a loss. He sold here. He got stopped out here. This order then disappears. It'll be filled, and this order disappears. As soon as the market reaches his stop automatically gets filled at the market, and he would exit with a loss. However, the stop protected him from a much bigger loss. When one order gets filled, the other one gets canceled. It does not matter which one gets filled. If his stop gets filled, his profit-taking limit order gets canceled. If instead the market goes here first, then the stop gets filled. Here's an example of a bull. Let's say he buys on a stop above the high of this bar. And he set up his software so that whenever he enters a trade, the market automatically creates a bracket order. With a stop below, a certain price below, he determines the price, and a profit-taking limit order above. Let's say his profit-taking limit order was up here. So as soon as he gets filled, he's long, and he had a limit order here, he can then quickly change the order to here if he thinks the market might not get much above this high. As long as the distance from here to there is at least the size of a minimum scalp, then that's an okay thing to do. On this bar, the market hit his limit order. However, it probably did not get filled. So his limit order to take profits is still alive, and his stop is still alive as well because he's still in his long position. As soon as the market went above his limit order, then he gets filled, and this order, the stop order, automatically gets canceled. He no longer has a position when he gets filled here. He exited his trade, so he no longer needs a stop order. If this order was not canceled, it would still be active. He'd be out of his position here. When the market came down and hit his stop, he would then find himself short. Bracket orders, as soon as one gets filled, the other order gets canceled automatically. There are many other types of orders. The only one that most traders ever need is a market order. Again, most traders should only be entering with stop orders, and they can exit either with a stop or limit order, the bracket order. A stop order can protect them against a big loss. A limit order can be used to exit with their profit. Sometimes the market is moving very fast and you have to make a very quick decision, either to exit a trade that you're already in or to enter a trade. And sometimes it's just better just to get in or get out immediately and not wait for your stop to be hit, or not wait for a pullback that would allow you to enter at a better price with a limit order. And that is why all brokers have an option to create market orders. If you select market, for example, buy market, you'll get filled immediately at the market. If you pick sell market, you'll get filled immediately at the market. If you're long and you hit sell market, you'll immediately exit. If you're short and you hit buy market, you'll immediately exit. Buy orders, buy market orders, they're filled at the offer. In other words, slightly above. And sell market orders are filled at the bid, slightly below. The bid-ask spread. Brokers always make you buy at the worst price and sell at the worst price. Let's say over here, you're thinking, maybe I should buy, maybe I should not buy. Maybe I'd like to see the market start to move up quickly before I buy. And as it's starting to go up, you decide, I got to get long. You can just buy at the market. Just hit the button on your software, buy the market. Your software should automatically create a bracket order. For example, you might want to sell on a stop below this low. And let's say you're planning on taking a scalp profit. The market reaches your scalp, but you think it might go higher, and then you're disappointed by this big sell-off, and you change your profit-taking order to be right at this high, and you would get filled there. As soon as your limit order is filled, your stop gets canceled. We have a trend going up here, and the market falls below a bull bar. You might decide that it's not likely to go down very far, and maybe you buy at the low of this bull bar, betting that we'll get another higher low like this. For example, you buy here, your bracket order would be a stop down here to get you out if the market fell below this low, or maybe below that low. And maybe you're hoping for a test of this high, so you have a limit order at that high. However, after you enter at the low of this bar, you get a second bear bar closing on its low. You then decide that your premise is wrong, that we're probably not going up. This might be a wedge top, 1, 2, 3, and a reversal down, and we have a follow through. At the close of this bar, a bar closing on its low, you decide, I just want to get out. I don't want it to hit my stop, I'll lose more. As soon as this bar closes, you hit sell market, and you get filled as soon as the next bar opens, and you reduced your loss instead of waiting for your stop to be hit. We have a strong reversal down, and we have a second bar closing on its low. A lot of traders will see this as a sell the close market, a strong bear trend, where you can make money by selling closes. If you think it's a sell the close market, as soon as this bar closes, you hit the button on your software, sell the market. And you get filled immediately after you hit the order, and you get filled early on during this bar with a market order. Your software should immediately create a bracket order with a stop and a profit-taking limit order, and you might want to move the stop order so that it's just above this high, and you might want to change your limit order maybe to a measured move down, maybe based upon the height of this close to that high, maybe a little bit more, and you might drag it down here. In this particular case, you might be thinking the reversal down is strong enough for a swing trade, and I'll place my limit order down here. Your software will automatically cancel the order that is not filled as soon as one order is filled. If the market comes up here and hits your stop, this gets filled. If it comes down here to hit your profit target, your profit taking limit order, you get filled, you're no longer short, your stop automatically gets canceled. There are many other types of orders, and many brokers offer lots of other choices for you. When I started trading 30 years ago, stop limit orders and marketable limit orders were pretty popular, and they were used, I think, mostly to protect traders against floor traders and unethical brokers and firms who were basically stealing money from traders. But now orders are computerized, and you don't have to worry about the floor traders stealing from you, and therefore stop limit orders and marketable limit orders are no longer useful. Your broker may brag that he has a variety of special types of orders. They're a waste of your time. They rarely ever offer any benefit, and when they do, the benefit is very small. You stand to make much more money just focusing on managing your trades well than using these other types of orders. You should stick to the 4 types that I talked about in this video. If you're a Forex trader, you have to be aware of some peculiarities of the Forex market. First of all, the charts are not based upon actual trades. They're usually based upon the bid or the ask or the midpoint or something else. And there may never have been a trade that takes place at a particular price on the chart. So for example, if this were a Forex chart, it looks like the market traded to this high and turned down. It might not have. If this is a chart that's only showing ask prices, the market may not have ever reached that price. It's not showing trades, it's showing asks. Likewise, if it's only showing bids, it may never have reached this price. And the problem with that is stop and limit orders that you think should get filled by looking at the chart are not filled, and it's because the chart is not showing actual trades, it's only showing bid prices and ask prices. I discuss this in detail in the videos on Forex Basics in the trading course. It's very important to understand that brokers are not held. And not held is a legal term, and what it means is that anything that goes wrong is your fault. You cannot hold them responsible. For example, if you think that your order should have been filled at a particular price, but it was not filled, call your broker. However, 99% of the time, if you think you should have been filled or you should have had a different fill, it's because you made a mistake and you simply did not realize it. The 1% of the time when it actually is the broker's fault or the exchange's fault, it's still your fault. It's very rare for them to change a trade and do what is right. I've had it happen maybe a couple times in 30 years. Whenever you open an account, you sign a contract with your broker, and one of the clauses in that contract says not held. And it means that the broker is not responsible for any problems filling orders or not filling orders, or for bad fills. And if you're unhappy with a fill or with the absence of a fill, it's always your fault, even if it's not your fault. That's just part of trading. In this video, I talked about stop orders. Most traders should only be entering with stop orders and nothing else. Also, you need protective stops to protect yourself against disasters. However, they don't always protect yourself against disasters. There are some disasters that can cost you a lot of money, even if you have a protective stop in the market. Experienced traders can enter with limit orders. All traders should be using limit orders to take profits. Bracket orders, you should set up your software so that as soon as you're in the market, the software immediately creates a bracket order, a protective stop in case the market goes against you, and a profit-taking limit order so that if the market goes your way, you can exit with a profit. Market orders are handy sometimes, but you usually will not use them. They're handy to get out of a bad trade that's going quickly against you, instead of allowing the market to hit a stop and creating a bigger loss. They're also handy to enter a trade that's going very quickly in the direction that you thought it would enter, and you do not want to wait for a pullback. All other order types, I think, you should avoid. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on orders. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on orders. I keep making the point that stop orders are better for most traders when you enter trades. Skilled traders will also use market and limit orders to enter trades. If a trading range is pretty tight, it's a limit order market, and most traders should not trade when the range is tight. They should instead look to trade when the market has reasonably good swings or trends. Most traders should enter every trade using a stop order, because for a stop order to get filled, the market has to be going in your direction, and that slightly increases the chances that you'll make money. For example, we have a swing up here and then a pullback and a bull reversal bar. To buy using a stop, you place your stop order just above the high of this bar. If it's a Forex market, you place the order 1 pip above. If it's a stock or a futures contract, you place the order to buy 1 tick above the high of that bar. You're buying on a stop. This bar is the signal bar. If this bar goes above the high of that bar, which it did, it becomes the entry bar. As soon as the market goes 1 tick above the high of the signal bar, your stop order is touched, and that makes it a market order, and you get filled, usually at the stop order price, sometimes a little bit worse. Rarely better. Sometimes it'll hit the stop and it instantly goes down. That's very rare. Usually you're going to get filled at the stop order price. Maybe 5% of the time, 10% of the time, you get filled a little bit worse. I talked earlier about bracket orders, and you should always have a bracket order whenever you enter a trade. As soon as your order to enter gets filled, your broker's software should allow you to program both a protective stop and a profit-taking limit order, which I do not show here. At a minimum, though, whenever you enter any trade, you should immediately place a protective stop somewhere that makes sense. For example, below the bottom of a signal bar or below the bottom of a bull trend. Most traders should always be going for a reward that's equal to at least twice their risk. If their initial risk is here, a reasonable target is 2 times the initial risk. So traders will exit with a limit order at that price. And you can see what happened when the market reached 2 times the risk. You buy here, your initial risk is here, 1 times risk, 2 times risk. You can see there was selling. Most of that selling is from bulls taking profits. Some of it is from bears who expect the bulls to take profits, and they're shorting for a scalp. In the video on risk, I talk about initial risk versus actual risk, and I'm using initial risk here. You're initially risking here. If you get filled here above this bar, the market might have pulled back here and went up. Your actual risk was only to just below the low of that bar, and it's less. However, it's always reasonable to try to go for a reward equal to 2 times your initial risk. Again, beginners should only be entering with stops. They want to be swept into the trade by the market going their way. That makes it easier emotionally. Even if the market's only going your way 1 tick or 1 pip, psychologically it's easier to manage the trade if the market is going your way. Anytime you're entering with a stop, you're entering on the breakout of the prior bar, betting on a profitable breakout. For example, if you're buying with a stop here, you're buying a breakout above the high of that bar. If you're buying above this bar, you're getting filled once the market breaks above the high of that bar. If you're selling with a stop, for example, below the low of this bar, you get filled when the market breaks below the low of the bar. You're entering in the direction of a breakout. A limit order trader is doing the opposite. I'll talk about that later. Stop orders, they're good during trends. The market's going up. If you buy above a bar, the market has to go up for you to be filled. That's the direction the market is heading, and there's a higher probability that you'll make a profit. When the market starts to go sideways, stop orders are bad. Selling below this bar, buying above this bar, buying above that bar, selling below that bar. In a very tight range like this, it's a limit order market. Beginners should only be trading with stop orders, and that's the exact wrong way to trade a market in a tight trading range. And therefore, beginners should not trade when the market looks like this. This is a limit order market. Traders buy below bars looking for scalps. They sell above bars looking for scalps. They buy below prior lows looking for scalps. And that is beyond what a beginner should be doing. Again, entering with stops above this bar, above that bar, selling below that bar, buying above this bar. Stop orders are going to lose too often. When the range is tight like this, you should not be trading at all, and you certainly should not be trading with stop orders. Experienced traders enter at the market, and they'll also enter with limit orders. And both of those are, I think, beyond what a beginner should be doing. He'll make too many mistakes and he'll lose money. If the context is good for a swing up and a bull sees a bull bar closing on its high, a good sized body, and then a second one, bulls will start buying closes here or here. As soon as the bar closes, they hit buy the close, and they get filled at that price. They might get filled on this bar just as it closes if they enter right before the close. If they enter at the close, they'll get filled on the open of the next bar. That's a high probability bet that the market is going at least a little bit higher. After a beginner has some experience with stop orders, he can start experimenting with some market orders. Buy the close markets, strong bull trends, buying closes, or in a strong bear trend, selling closes. Experienced traders will also enter at the market. If they feel like the market is racing up with a lot of momentum and is likely to go higher, instead of waiting for a pullback, the trader might simply hit the button to buy the market. For example, if the market's going up and he hits buy the market, it might get filled here a little bit above the instant when he hit the market order, betting that the market would go up at least a little bit higher after this much momentum. Experienced traders will also enter with limit orders, betting that reversals will fail, for example. Very strong bull trend, very tight bull trend, a lot of bull bars closing on their highs, a weak sell signal bar. Do you think there'll be more bears selling with stops below that bar, or more bulls buying with limit orders at the low of that bar? An experienced bull will place an order to buy at the low of that bar. He'll get filled here. He'll put a stop maybe below the bottom of this breakout, probably below the bottom of this bull trend. The market's going against him. It's falling and has a strong bear bar, but he's confident in his position. He'll hold long. He might even add on lower. That is a type of trade that is very difficult for a beginner to do. If he buys at the low of this bar and he sees this big bear bar, at one point this was also a big bear bar. It ended up closing on its high, but at one point it was a second consecutive big bear bar, and a beginner would feel too much stress to manage the trade correctly. The bars are starting to get small. We have big up, big down, big up, big down. We're probably going sideways. Expert traders will start selling above bars. After 5 bars down, 4 of them bear bars, bulls will bet the first reversal up will form a lower high and there'll be a second leg down. Bears will bet that there'll be sellers above the high of this bull bar and a second leg sideways to down. They'll therefore sell with a limit order at the high of the prior bar and possibly add on higher looking for a scalp. They're betting that the breakout above the high of this bull bar will fail. There'll be sellers above and the market will trade down far enough for a scalp. In a tight trading range, limit order bears will sell above bars. Limit order bulls will buy below, betting that breakouts will fail. They'll also buy at the prior low. Again, this is more than what a beginner should be doing. A bull might place an order to buy at the prior low, this low or that low. He'll get filled here. Even though it's a bear bar closing on its low, the bull will bet that the trading range will continue and that any breakout down or up will fail, and therefore buying a bear breakout will lead to a profitable scalp. Every time you see a tail on the top of a bar or on the bottom of the bar, it's a failed breakout. If the market has a lot of bars with tails and a lot of overlapping bars, it has a lot of bars that are failing to break out above or below the prior bar. And therefore, instead of entering with stops betting on successful breakouts, you have a better chance to make money if you enter with limit orders betting the breakouts will fail. Again, this is something that only experienced traders should do. A market that has lots of reversals is bad for stop orders. If it's bad for stop orders, a limit order is basically the opposite side of a stop order. It's good for limit orders. Big tails on the tops of bars, the breakouts are failing, more sellers than buyers as the market's going up. Therefore, traders will sell breakouts betting that they'll fail. They'll either sell the high of the prior bar, for example here, sell the high of this bar, betting the breakout will fail, or they'll sell at the high of a prior high. For example, they'll place a limit order at this high, betting that the breakout above it will fail. Again, limit orders are bets that breakouts fail. Stop orders are orders betting that breakouts succeed. They're basically opposite of one another. Big tails below bars, the breakouts are starting to fail. Bulls see that, and they'll place limit orders to buy at prior lows and at the low of the prior bar. For example, they might buy at the low of this bar or at the low of that bar, or if the market falls below this low, they'll buy as well. They're betting breakouts will fail. Again, stop order traders are selling at that low, betting on a successful breakout. When the market's in a trading range and it has a lot of tails and a lot of reversals, that is a bad bet. More likely, there'll be buyers at that low, not sellers. And therefore, buying that low has a better chance of making money than selling on a stop just below that low. This is a limit order market, a trading range. Bad for stop orders, good for limit orders, because they are doing opposite things. The stop order trader is betting on a successful breakout. The limit order trader is taking the opposite side of that trade. He's betting that the breakout will fail and reverse. Whenever you look at a chart and you're not really clear of the direction, if there are a lot of dojis, a lot of tails, a lot of overlapping bars, a lot of little reversals, the probability is bad for stop order traders. Also, if the bars are big, then the risk is big. The stop is going to be far away. Your protective stop is going to be far away. For example, buying above the high of this bar, we have a lot of reversals. The probability is we'll get another reversal. The probability for a stop entry bull is small. The bar is big, so his risk is big. Therefore, you have a bad risk-reward ratio and a low probability. If you're going to take the trade, it makes more sense to do the opposite, to sell at the high of that bar instead of buying just above the high of that bar. Stop and limit orders are basically the opposite side of the same trade. Very big bull reversal bar, but lots of reversals. Big up, big down, big up again, probably trading range rather than bull trend. And therefore, buying at the high of anything is usually a losing strategy. It's a low probability bet. Experienced traders instead will place a limit order to sell that high, betting that instead of a bull trend, the market will go sideways and he'll make money selling above bars, betting that bull breakouts will fail and reverse far enough to make a scalp. Therefore, probably more sellers at this bar's high and above its high than there are buyers. It's a limit order market. Since 95% of all trades are traded by institutions, you should assume that for every trade, one institution is buying and another one is selling. You also have to assume that both are doing something that is rational. How can it be rational for one institution to buy and another institution to sell? Well, 90% of the bars on every chart are either in a channel or a trading range, and if you manage your trade correctly, scale in, you should be able to make money buying or selling at any given moment. One institution is buying above this bar, betting that the market's going to go higher, but that institution may also be willing to scale in lower. For example, right here, again entering on a stop, betting that this was a rational buy, therefore the market should get back to that price. He can get out break even in his first buy and with a profit on his second buy. Another institution will do the opposite. He'll sell this high, betting that the market will turn down and he'll be able to make a profit. Another institution will sell this high, betting that at worst it's a trading range. It could be a bear trend. And if it's a trading range and rallies, it'll come back down to that price. And if he sells more higher, he can make a profit. You can see the market got down to that price and the market went up. Part of the reason it went up is bears sold here, they sold more higher, and they're buying back their shorts at their original entry price. Some bulls will buy below this bar, betting that we have consecutive bull bars. The reversal down will probably not get very far. Here you have a wedge, 3 pushes down, 1, 2, and 3. And you have dojis, tails on the bottom, traders are buying lows. Some bulls will buy at the low of that bar, betting that it's a bad bear flag. It's a bear trend, but it's also probably a trading range at or around the bottom of the bull trend. And we keep getting reversals: bear bar, bull bar, sell off, rally, sell off, probably a rally. Therefore, bulls will buy at the low of that bar, betting that the bear breakout will fail and that we'll get a reversal up. Bears, they'll sell with a stop, betting on a bear breakout. Some will even sell down here, hoping that it's a bear channel that just continues down all day. They're confident that with a channel this tight, worst case is any rally will be minor and lead to a trading range rather than a bull trend. If they sell here and scale in higher, they can avoid a loss and usually make a profit. Remember, 10% of the bars on a chart are in a strong breakout, and you should only trade in the direction of the breakout. 90% of the time, there's always an equally valid trader's equation for the bulls and the bears, if they manage their trades correctly. Again, during a strong breakout like this, it's better only to sell, because the first leg down will probably be followed by a second leg down, and the first reversal up will probably be minor, either a bear flag or a bull leg in a trading range. In either case, the market should trade back down. What's better, a stop order or a limit order? Well, they're equally effective. At any given instant, the probability that the market is going up or down is just about the same. If you look at any chart, a limit order or a market order wins about as often as a stop order. Half the time, stop orders are better, half the time, limit orders are better. The more the market's going sideways, the more often a limit order will make money. The more the market is trending, the more a stop order will make money. Here, a trader wins selling with a limit order at the high of that bar. And over here, we have a failed breakout above this high, a little bit of a parabolic wedge, 3 pushes up, 1, 2, 3, 2 small legs up, 1, 2. It's a reasonable short for a stop order trader, betting that the reversal down will be profitable. Beginners should only enter with stop orders. Rarely, with some experience, they can begin to enter with market orders or limit orders, but only in the direction of strong trends. Experienced traders, they use limit orders just as often as stop orders. Some traders have a preference for stop orders. Other traders prefer trading range scalps and they prefer limit orders. But in general, expert traders use both. A trading range is a limit order market. A trending market is a better market for stop orders. A trading range is a limit order market, especially if the range is tight, and it's better to buy low, it's better to sell high, it's better to take quick profits, betting that the leg is not going to last very long. You buy low, you sell high, you scalp. Can you buy here? We have a wedge bull flag, we have a breakout and a pullback, and here we have another bull breakout and a pullback. Can you buy above here? Sure, but if you're buying near the top of a trading range, the probability is you're going to get a reversal down. To make money, usually you need to have a stop below, and it's better to scale in lower. Buying at the top of a trading range, your stop is down here, so the risk is big, and the probability is not very high unless you're willing to scale in. Buying up here, your stop is below the bottom of the most recent major high or low. We have a good reversal up here and a slightly new high, and therefore this is a fairly significant high or low, a major high or low. If you're buying up here, then your stop is just below that low. Buying high means the risk is big, the stop is far below. And buying at the top of a trading range means that the probability of making money is low, unless you're willing to scale in lower and use wide stops. Big risk and low probability means bulls buying with stops at the top will lose money unless they manage their trade correctly. Instead, bears selling with limit orders, betting that bull flags at the top of the trading range will fail, have a much better chance of making money. Experienced traders would rather be selling above bull flags at the top of a trading range, in other words, entering with limit orders at the high of the prior bar or at this high, at the high of this bar or at this high, betting that the breakouts will fail and lead to another leg down in the trading range and test near the bottom of the range. Trading range, a limit order market. It's better to enter with limit orders selling near the top, buying near the bottom. But again, you only do that once you're an experienced trader. If a bear sells with a stop near the bottom of a range there, here, or here, his stop is far away. That means his risk is big. An experienced trader can make money selling low in a trading range, but only if he's using the appropriate stop and scaling in and exiting appropriately. The stop for a bear selling here, it might be at the top of this final leg down. It might be at the top of the trading range. In any case, selling here, the stop is wide. The risk is big. Selling below this small bear flag, stop up here, big risk. Strong sell-off, we have a small bear flag. Selling at the low of that sell signal bar, the risk is very big. Since most trading range breakout attempts fail, selling at the bottom of the range is betting on a successful bear breakout of the range. It's probably going to fail. That means the probability of making money selling near the bottom is low. You have big risk selling at the bottom of a range. The stop is far away, and the probability is low. And therefore, selling with stops at the bottom of the range, it's difficult to make money unless you use the appropriate stop and scale in higher, and that's something most traders cannot do. However, bulls know that. They know the risk for the bears is big. They know the probability for selling at the bottom is bad, and therefore bulls will buy with limit orders below bear flags, betting that the bear breakout will fail, reverse up, and go up high enough for the bulls to make money. They'll buy at the low of that bar, get filled here, and make a profit on the rally. They'll place a limit order to buy at the low of this sell signal bar or at that low, betting that the bear breakout will fail and they can make money on a buy scalp. They'll buy at the low of this bar, betting the bear breakout will fail. They'll buy at the low of the leg down, betting on a reversal instead of a breakout. Buying with limit orders will make money. Selling with stop orders at the bottom of a range will lose money. If the range is tight, most traders should not trade. Whenever a trend is strong like this, it does not matter what type of order that you use. All that matters is that you trade in the direction of the trend. Here it's a strong bear trend, so you should only sell. And you can sell with stop orders below bars, you can sell with limit orders above or below bars, you can sell with market orders, you can sell at any time. When the market's in a strong trend, only two things matter. You can only trade in the direction of the trend, here sell, and the other thing is you have to get into the trend. You have to sell. And you can do it with any kind of an order, stop order, market order, or limit order. When a channel down is very tight, the pullbacks are small, they only last a bar or two, some traders will sell at the market. Also, they're starting to get strong bear closes, traders will sell the close. As soon as the bar closes, they hit sell the market, or right before it closes, they hit sell the market. Sometimes as soon as it closes, they place a limit order to sell at the close of the bar, hoping to get filled on the next bar. However, sometimes the next bar does not go above the close of the prior bar and your limit order does not get filled. It's usually better just to sell the market when you think it's a sell the close bear trend. Anytime the market is trying to reverse, bears will sell with limit orders at the high of the prior bar, betting that the reversal will fail and become a bear flag and the bear trend will resume. The bull's trying to get a reversal? Well, most reversals fail, and the first reversal is usually minor. Bears will sell the close of a strong bull bar, betting that the reversal up will fail and the bear trend will resume. Bears will also enter with stops below every reversal attempt, thinking that the reversal attempt will be a bear flag and that the market will continue down. They'll place a stop order to sell just below the low of the prior bar. When traders start out, they should only enter with stop orders. In fact, most traders should enter with stop orders throughout their trading careers. Skilled traders often use market orders and limit orders as well. When the market's in a very tight trading range, it's a limit order market, and most traders should not trade at all. When the market's in a strong trend, traders should enter with any kind of an order, a stop order, a market order, or a limit order in the direction of the trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on orders. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on orders. When you're deciding what to do with your orders, the price action should determine what order you should place and where you should place it. I want to talk a little bit about limit orders, trading with the trend, and trading against the trend. Also, traders can sometimes enter earlier on a smaller time frame chart, reducing their risk. When the market has big swings, consecutive trend bars, not much in terms of tails, not much in terms of reversals, traders can enter with stops or limit orders. Strong bear trend, you can enter with stops below bars, you can sell at the market, you can sell with limit orders above bars, betting reversals will fail. Strong bull trend, you can buy with stops above bars, you can buy with stops above bars here, you can buy with limit orders below bars, betting that reversals will fail. However, when there are lots of reversals every few bars, the market goes the opposite way. Every bull bar followed by a bad follow-through bar, a series of bear bars with bad follow-through. And the market is mostly horizontal, and many bars have prominent tails. You can see almost all bars have fairly prominent tails. This is a bad environment for stop entries. Most traders should not trade when the market is starting to look like this. However, experienced traders will enter with limit orders, selling above bars, buying below bars, and scaling in lower and scalping. This is a bad environment for stop orders. A stop order is a bet that a trend will continue. When the market looks like this, stop orders are going to lose money because the trends keep reversing. It's more of a limit order market, betting that breakouts will fail, selling above bars, betting on a reversal down, buying below bars, betting on a reversal up. When the market is very tight in a range like this, most traders should not trade. They should simply wait. Experienced traders will trade with limit orders and they'll scalp. Sometimes when you look at a chart, you're not sure if it is early in a trading range or if it's in a weak trend. When you're in doubt about what to do, you have 3 choices. One is you can wait for a second or third signal with a good signal bar. Another is you can wait for a strong breakout, and then you have high probability, but your stop is further away. And third, you can simply wait for a clear signal. For example, do you buy here betting on a double bottom? Do you buy here, a second entry buy? This is an example of a second entry buy. 3 bear bars, a bear trend, low probability buy. But now we have a second reversal, a second attempt at bottom. You can call it a final flag reversal, a lower low. We have lots of doji bars, bars with prominent tails, and the market's going sideways. It's probably an early trading range. Here you're buying a second entry at the bottom of the range. This is a higher probability buy. Tight trading range, if you're looking to sell, here's a first entry short. The market fell below this bear bar right here. It fell below this bear bar here, so that's a second entry. And here's a third attempt. Whenever you have 3 reversals in a horizontal trading range, you can call it a triangle if you want. You can also call it a third entry short. The third entry has a higher probability of success. We're getting a breakout. The first reversal down, when this bar fell below that bar, not a high probability short because we have 5 consecutive bull bars. We have a lot of trading range price action here. Most breakouts above trading ranges fail. It's higher probability to take a second entry short. The first entry was this bar falling below that bar. Traders would then place a stop order to go short below this bar, which would be a second entry short. The market's in a fairly tight bear channel. Traders will sell below pullback bars. For example, we have a pause bar here, an attempt to reverse. this is a strong enough breakout. We'll probably get at least a little bit more down. Traders would therefore try to sell below the low of this bar. These two bars have the same low. The trader would get filled on this bar, betting that there would be at least enough trend resumption down for a profitable trade. Even though after the breakout there's a bull bar, bad follow through, the bar afterwards had a bear bar. Sometimes the follow through occurs on the second bar, not the bar after the bear trend bar. When the channel is tight like this, the odds of a reversal up going very far are small. Most likely any reversal up is going to be a bear flag, or possibly a bull leg in what would become a trading range. If we went up 5 or 10 bars, we probably would come back down and test this area. So a trader selling here could sell more on a rally, expecting the market to come back down here. A tight bear channel is unlikely to become a bull trend. The best the bulls usually can get is only a trading range. If you sell here, you can sell more higher. Trading range, you expect it to come back down. Very tight bear channel, strong breakout, probably at least a small second leg down. This is the second leg down. Would you buy above this bull bar? Well, I don't know. You got 2 consecutive bear bars. Now you have a micro double bottom and a lower low, basically a double bottom, this low and that low, and this is a micro double bottom. A micro double bottom is a type of second entry buy, and therefore it's reasonable to buy here, betting on at least a minor reversal, possibly a major reversal. Probably not enough bars for a major reversal, probably good enough for a profitable minor reversal up and a profitable buy. Traders can use limit orders when they're trading in the direction of the trend, betting on reversals failing, and they can also use limit orders betting on a reversal in a trend. We have a bear trend here, a bull trend here. Trends are always trying to reverse. When the market's in a reasonably strong trend during a breakout, there's a breakout here, traders will bet that reversal attempts will fail. For example, they'll buy with a limit order at the low of this bar, betting that there'll be at least a small second leg up. When the market is starting to look like a trading range, traders will bet that breakout attempts will fail. For example, they might sell above the high of this bar, betting that the first reversal up from a tight bear channel is likely a bull leg in a trading range. So they'll sell at that high, betting that the reversal up will fail. Likewise down here, we're starting to get a lot of doji bars, trading range types of bars. Traders would look to buy below the low, the prior low, betting that the reversal will fail and that the market will stop being in a bear trend and start entering a trading range. We have 5 bear bars after a wedge top. A second leg down is likely. Wedge top, 1, 2, 3. 5 bars down. 2 of them are dojis, but 3 are pretty good bear bars closing on their lows. The market will likely have a second leg down. This is a bear trend. Traders will bet the reversal up will fail. They'll place a limit order to sell above the high of this bar or above the high of this bear bar. They'll get filled here. And then they'll look to take a profit somewhere down here. We have a reversal up, a second reversal up, and a third reversal up. This is a wedge bottom. After a fairly weak trend, not much in terms of consecutive bear bars. We have a bear bar, doji, 3 bull bars. Bear bar with tail, dojis, bull bars. This is a weak sell-off, probably a bear leg in what will become a trading range. Traders will look for reasons to buy a reversal up. We have a wedge bottom, and we have a strong bull breakout bar and a bull follow-through bar. Strong enough so that the market will probably have at least a small second leg up. Bears will see this as a double top. Bulls will correctly decide that it's more likely there'll be buyers below this bull bar. We have a bull breakout bar, a big bull bar. We have a follow-through bull body, even though it's small. We have a wedge bottom. We have a lot of trading range price action. Bulls will place a limit order to buy at the low of this bar. They'll get filled here. They'll put their stop down here, betting on at least a small second leg up. They're using a limit order to trade in the direction of a bull trend. Just like the bears who sold here were using a limit order to trade in the direction of a bear trend. Traders will also use limit orders to bet that a trend will fail. They'll be trading counter trend. Traders see a reversal down, and then a big doji bar at the top of a wedge channel. Some traders will bet that the breakout above the channel will fail, and they'll place a limit order to sell at the high of this bar or at the high of this bar. If they sold at the high of this bar, their order would not be filled. But if they placed a limit order to sell at the high of this bar, they'd be filled right here, betting on at least a couple legs down from the wedge. This is betting against a trend. This is using a limit order, betting that a trend is about to reverse. We have a bear sell-off, but we're getting bad follow-through, dojis, prominent tails, sideways bars. The bulls who bought at this low had a bounce, maybe enough for a scalp. The bulls who bought at this low, again, probably made enough for a scalp. Therefore, bulls are assuming the market might be entering a trading range, and they'll look to buy prior lows, and sometimes they'll even look to buy below a bear flag. Here we have a double top bear flag, and we have a good bull bar here, a better bull bar here. Some bulls will place a limit order to buy at the low of this bar, just in case the market does not fall below this low. They'll place a limit order, they'll get filled here. It does not matter that it fell a little further. Some bulls would even buy more at this low, betting that we're entering a trading range, and will probably get a bounce that's at least big enough for a profitable scalp. Again, bear trend, but bulls buying either at the prior low or below a low 2 bear flag. We have a double top, therefore it's a low 2, low 1, low 2. They'll place a limit order to buy at that low for a scalp up, betting that the bear trend will evolve into a trading range, and they'll be able to make a profitable scalp. We have a strong rally, but it's about a 50% correction. And we have a pullback, 3 consecutive bear bars. The bulls are trying to resume, but bad follow through. Another bull bar, bad follow through. Some bears will sell with a limit order at the top of this bear bar, betting that there's not enough momentum up for the market to go much higher, and therefore this might be the start of a trading range rather than the start of a bull trend. They'll sell with a limit order at the top of this bear bar, betting that maybe it's a low too short. We have one leg up, reversal, second leg up, trying to get a third leg up. They'll bet against a successful bull breakout and instead a trading range. We have an early bull trend. We have a breakout, a bull flag, a weak breakout of the bull flag, bear bar, bear bar. Traders will place a limit order to go short at the high of this bear bar, and they'll get filled here, betting that the bull trend will fail. They're using a limit order to bet against a bull trend and instead bet on a trading range. The market is starting to rally. We have a series of consecutive bull bars, but we have a lot of bear bars here, and this high is a double top with this high. This high is also a double top with this high. It looks like the market's evolving into a trading range. Here's a high 1 buy, but a bear bar, and the market did not go up very far. Now we have a high 2 buy, but a bear doji. Probably not going to be a very profitable buy. Some bears will sell at the high of this bar, betting against a successful bull breakout, and instead betting the bull breakout will fail and that this will become a trading range. They're betting against a successful breakout and continuation of this bull trend. They're trading counter trend with a limit order, selling at the top of a rally. When the market looks like it might be entering a trading range, very tight bear channel, first reversal up, probably minor, a bull leg in a trading range, traders will sell at prior highs. Here's a prior high. Traders will place a limit order to sell. They'll get filled here. They'll put a stop above this bear trend high. And the same thing here. We have a major high. It led to a new low. Bears will sell with a limit order at the high of this bar, and they'll get filled here. And even here, they'll sell with a limit order at the high of this bar. We have another high here. The market's going above it. They'll sell here. Different choices, all close together, but all are adequate choices. Stop above the top of the bear trend, betting that this rally is not strong enough to be the start of a bull trend. Instead, it's probably 2 legs up in a trading range, 1 pullback 2, and that if it's a leg up in a trading range, it'll be followed by a leg down. And the bears, therefore, are betting against a successful trend, betting in favor of a trading range, selling at and above prior highs. We have a bull flag, 4 consecutive bull bars, but a bear bar at a prior high and around a 50% pullback. That's not a very good looking bull flag. Bears will place a limit order to sell at the high of this buy signal bar, a bear bar, and a possible double top. The same true here. We're getting a bull breakout, but again, a bear bar. This bar has a prominent tail on top as it's breaking above this prior lower high. It's a lower high compared to the top of the bear trend. Traders expect this is a bad buy signal bar, a bad bull flag. They'll place a limit order to sell at the high of this bar, and they'll get filled right there. And the same is true at the bottom of what they think is a trading range. A double top bear flag, but bad follow through, a lot of prominent tails, a lot of trading range price action. The entire sell-off looks like a bear leg in a trading range. Traders will begin to buy at the low bars, betting that bear breakouts will fail. They place a limit order to buy at the low of this bar, and they get filled right here. Here we're getting a bull reversal, fairly low down in a possible big trading range. Bulls will bet that this double top bear flag will fail. This breakout is strong enough for a second leg up. They'll place a limit order to buy at the low of this bar. The bears see a double top bear flag and a bear trend. The bulls see a wedge bottom, 1, 2, 3, and a strong reversal up. Probably we'll get a second leg up. Bulls will place a limit order to buy at the low of this bar, and their order will get filled right here, and their stop will be here. A lot of trading range price action. Does not look like a strong rally. It lacks consecutive big bull trend bars. Does not look like a strong sell-off. It lacks consecutive big bear bars. 2 big bear bars here, but a doji here. Bear bar here, but a doji here. A couple bear bars here, but a tail. Traders will look to buy at a prior low, looking for a scalp up. And trading range price action, they'll sell at a prior high, betting on a reversal down. So they buy this low. They place a limit order as the market is falling. They place a limit order to buy this low. As the market's falling again over here, they'll place a limit order to buy this low, each time expecting the breakout to not fall very far and to bounce enough for them to get a scalp. A lot of times they'll buy this low, they'll get filled here, and they'll try to buy more down here, as long as their second entry is at least as big as a scalp. If they buy here and they buy more here, if it's the size of a scalp, and the market reverses back up to their first entry price, they get out break even on their first entry and with a scalp profit on their lower entry. We have a reversal down, a second reversal down. A lot of traders will assume the bull bars are not big enough and powerful enough to lead to a bull trend. We have a tail here, we have 3 bear bars here. They'll bet that the breakout attempt above the top of this bull channel is likely to fail and lead to a wedge. They'll place a limit order to sell at that top of the channel, looking for at least a scalp down, maybe a couple legs down. Here we have what looks like a trading range. We have a series of bull bars here, but fairly prominent tails below and a little bit above. Some traders will place a limit order to sell at a measured move up. Certainly the bulls who bought, if they held, this is a good location to take profits, near the top of the range, above this bar, betting that the market will fail in its breakout attempt. And then you also have a measured move up. We have a breakout, a pullback, and a gap. A little bit of a negative gap. We fell below that low, but still a potential measured move up. Some traders will place a limit order to sell at that high, either to take profits on their longs or to sell at least for a scalp. Wedge bottom, 3 pushes down, 1, 2, and now 3. A lot of trading range price action. This is probably a bear leg in what will become a trading range. Traders will therefore place a limit order at the bottom of this channel, and they get filled right here, betting on a couple legs up. That's also a leg 1, leg 2 measured move. Leg 1, pullback. Leg 2, this is the size of this first leg. Traders expect to see some buying at that price. That's an additional reason to buy. Fairly weak bull channel here and here. Traders will bet that the breakouts will fail to go far enough up for a scalp, and therefore they'll sell at the high of the prior bar, especially if the prior bar is a bear bar. We have 2 legs up, possibly a wedge, and now we have a big doji and a bull bar at the top of the channel. A lot of bears will sell with a limit order at the high of this bar or the high of that bar, betting that the bull breakout above the top of the channel will fail. Different ways to draw a wedge here. First push up, second push up, third push, or first push, second push, third push, fourth push. Traders will look to sell above bear bars, betting that they're bad buy signal bars at the top of a trading range or at the top of a weak rally. Also, they'll sell at prior highs. A good-looking bull bar, possible double bottom, we down here, but a lot of trading range price action, weak rally, bad follow through here, bad follow through here, bull bar, bad follow through here, big tails here. Traders will look to sell above bars, betting that they'll be able to make a profitable scalp and that this rally is not a bull trend. It's a bull leg in what will become a trading range. We have a bear channel, bad follow through, bear bars, bad follow through, bear bar, bad follow through. It looks like a bear leg in what will become a trading range. Traders will therefore look to buy with limit orders bear breakout attempts below the bottom of the channel. Bear channel, bulls will place the limit order to buy there. We have a bad looking bear flag, a big tail here. We're trying to break out here. This looks like a bear leg in a trading range. Probably buyers at this low or not far below. We have a bull bar here. It's a bear flag, but a bull bar. Traders will buy either at the low of this bar or at this prior low. And the same is true here. We have a bull bar and a doji bar, not strong sell signal bars. Bulls will buy either at that low or at the prior low. And the same true here. We're getting a lot of dojis. A new low here is possibly a wedge. 3 pushes down, 1, 2, 3. Bulls will buy the new low, betting on a wedge and at least a small reversal. I want to talk a little bit about entering on a smaller time frame. If the context is good, you can often enter earlier, which means your risk is smaller. This is a 5-minute chart, and we have a very strong bull breakout. When you see a bull bar, a second big bull bar, traders need to get long. However, if they're buying here or here on the close, their stop is way down here. And it can be scary to be buying the close or buying at the market, and you don't have enough time to think. What I typically do is I try to buy at the market as the market is rallying strongly like this, betting that the momentum up is so strong, we should get at least enough follow-through buying for a profitable trade. Let's say you buy that close, your stop is below the low of this bar. This line is just a little bit below the low of the bull breakout. 60% chance you're going to get a measured move up from your stop to the entry bar before the market falls down here. So 60% chance it's going to go up here before it goes down here. It's scary to take the buy, but the math is good. An alternative is to wait for a pullback and buy over here. Some traders simply just are unable emotionally to take the buy the market or buy the close. An alternative is to take a look at a smaller time frame chart. This is a 5-minute chart. You can look at a 1-minute chart. And this is the same chart, but a 1-minute chart. Instead of buying that close, you might look at this and say, well, it's a pretty strong breakout. Maybe I'll buy the close on the 1-minute chart. Or we have a bear bar, a small pullback. Maybe I'll buy on a stop above the high of that bear bar, betting on some follow-through buying. As soon as I see 3, 4, or 5 consecutive bull bars, especially with 2 or 3 of them closing on or near their highs, and with the bodies getting pretty big, the odds are we're going to go at least a little bit higher. And therefore, I can buy for any reason. I can bet that the reversal down will fail. I can buy with a limit order at the low of this bar, or I can bet the breakout will fail and buy above the high of this bar, or buy above the high of this bar, or buy above the high of this bar. The risk probably is to the bottom of this bull breakout. Realistically, most traders would put their stop down here. However, the risk is less than it is over here on the 5-minute chart. Again, you can enter early. We have a bear trend, strong bear breakout. Big bear bar. A lot of traders are very uncomfortable selling the close or selling the close of the bear follow-through bar. It happens very quickly, not enough time to think about how to sell. You can sell the close of the breakout bar. We have a bear bar for a follow-through bar. You can sell the close there. You could bet the reversal up will fail and place a limit order to sell the high of this bar and get filled here. If you don't feel comfortable selling the close or selling above a bull bar or waiting for a pullback, you can take a look at a 1-minute chart, and sometimes you'll get an earlier entry. This is difficult to do if you're a beginner, but experienced traders can do this. Here's the same chart, but a 1-minute chart. This is exactly this chart, but this is the 5-minute chart. This is the 1-minute chart. 2 big bear bars closing on their lows. Some traders will sell at the market here, which would be right here on the 5-minute chart. As soon as you get 2 very big bars or 3 or 4 reasonably big bear bars, traders will look to sell any time frame. On the 1-minute chart, you get in a little bit earlier than you would on the 5-minute chart. You can place a limit order at the high of the prior bar, betting that the reversal up will fail. Or you can place a stop order below this pullback, betting that this is a bear flag and will go lower. You place a stop order below that bar, you get filled here. The price action determines what kind of order you should use. Beginners and most traders should only enter with stops. They can exit with limit orders to take profits, and they always should have a protective stop. Experienced traders will use limit orders either to trade in the direction of a trend, betting reversals will fail, or they'll use counter-trend orders, limit orders, betting that the trend is actually a leg in a trading range and it will soon reverse. Sometimes when you have a big breakout, it's scary and difficult to enter at the market or on the time frame that you're looking at. An alternative is to switch to a smaller time frame chart and look for an entry on that smaller time frame chart. I'm Al Brooks. This is the third of 3 videos on orders. Thank you for watching the Brooks Trading Course.